All right, traders, if you're buying call options because you're bullish, are you aware of what the delta is and the theta of that option is before you actually buy it? Because if you don't know what the delta and theta are of the options that you're buying, you may be making the wrong kind of trade. So in this video, I'm going to show you, if before you buy a call option, take a look at the delta and theta, and you can see, number one, what your chances are of possibly winning on the trade. Number two, you can see how much money you could possibly lose just because we flipped the calendar to the next day. And that's what theta is all about. So let's just jump right in and see what we can find. All right, everyone, Lee Lowell here from smartoptionseller.com. Today we're talking about two important Greeks, okay? If you know a little bit about the Greeks, there's four main Greeks that are a byproduct of the option pricing formula. And most people talk about delta and theta, and those are the two that I deem the most important. So I'm going to, in the cheat sheet here, this is what we call the cheat sheet, we're going to talk about delta and theta, and then we're going to look at the option chains. I'm going to show you some actual numbers, and then we're going to look at the probability calculator, and I'm going to show you why delta and theta are very important that you should know before you actually enter into any call buying trade. All right, so let's just talk about what delta and theta are, and then we'll look at the numbers. Number one, delta has a few different definitions, and every option contract has its own delta. So if you've been looking at an option chain, which you should before you actually buy a call option, you want to know its delta. And I'll show you the option chain where you can find that information. So the two most important definitions of delta that I use is that, number one, the delta of that option tells you how much that option price will change in conjunction with how the stock price changes. Now, if you've been trading options, you know that the price of that option contract is really dependent upon how the stock moves. Okay, so if you're bullish and you buy a call option, you want the stock to move up. But do you know ahead of time how much that call option price should move when the stock price does? Because if you don't, then you haven't been checking your delta. All right, so the deltas range from 0 to 100, 0% to 100%. And it tells you how much that option price should move along with the stock. All right, so if you have a delta of 50 and the stock moves $1, that option price should move up about 50 cents per contract, which is 50% of the option of the stock's movement. If you have an option contract, with a 90 delta, that means if the stock moves up $1, that call option should move up about 90 cents per contract, or 90%. If you have a 10% delta, the option is going to move only about 10% or 10 cents for every dollar that the stock moves. So you have to think about it. When you buy a call option, you want that option price to move in your favor quickly when the stock price moves. So think about it. If you buy a very cheap dollar-wise option, it's going to have a small delta, which means that option's not going to move that much, even though it's a lot cheaper. A high delta option will have a very high option price, but it's going to move when the stock does. So you have to decide, do I want a cheaper option so I don't have to pay so much money, but then I'm not going to get a lot of movement? But if I want a lot of movement out of my option price, then I got to buy higher deltas. So there's a tipping point. So most people sort of gravitate towards the 50 delta options, which are more the at the money. But the very important thing is that you need to understand where your break-even point is, and I'll show you how to calculate it as well. The second definition of delta that a lot of people use is the probability of the option being in the money at expiration. Okay, if you understand the moneyness of options, you want the option that you buy, you want it to be in the money at expiration. So hopefully that'll give you a profit. But just because it's in the money doesn't mean you will make a profit. If you buy let's say the stock's at 100 and you buy an at the money 100 strike call and the stock goes to 101 at expiration, that means that option's in the money by just by $1 though. But if you paid more than $1 for that option, prior when you first purchased it, it doesn't mean you're going to make a profit. You're actually going to lose money. So probability, the delta, just because it tells you that's the probability of it being in the money, doesn't mean it's going to make a profit. Okay, so that's pretty much delta. I'll show you the option chain and we'll take a look at those numbers. The next one is theta. Theta is very important, especially for option buyers. Theta is a number that tells you on a dollar and cents basis how much the option value or its price will decay each day. Just because we turn the calendar to the next day, that option is going to lose a little bit of its value every single day as it marches on towards expiration. So if you're holding an option and the stock's not going anywhere, it's just going along sideways, that option value is just losing value, decaying every single day. And as an option buyer, you're like, geez, I'm losing money every day. My option's decaying away because the stock's not moving in my favor quickly enough. Okay. And I'll show you the option chain. And what you need to know is that the closer to expiration options have a higher decay rate, meaning a higher theta. So if you're trading like a lot of traders like to do, these shorter term, more out of the money options, and the stock doesn't move, that option's going to decay on you very quickly. And you're going to be like, what the heck's going on? I'm not making any money. So the closer to expiration options have a much higher theta decay. Longer to expiration options have a smaller daily theta decay. And the higher delta options have less decay than at the money options. And we'll look at that as well. So I want to just lay the groundwork here for you to understand that if you're going to buy call options, you better know how the option's going to move. That's based on delta. And you better know how much money you're going to lose on a daily basis if the stock isn't going anywhere. All right. So let's take a quick look at the option chain and I'll show you exactly what that means. Okay. We're looking at Apple. This is an option chain of Apple. Call options on the left, put options on the right. And Apple finished around $263 at the end of trading on October 24th, 2025. So let's just look at some options here. So we're going to look at 27 days out, November 21st. This is the third Friday of the month. These are the regular monthly expiration, third Friday of the month. Now, if you were to buy, let's say, an at the money call option on Apple because you think Apple's going to go up in price and you're thinking, okay, I'm going to buy an at the money option because that's what I've been told and most people trade at the money options. So you look down the chain and the closest strike at the money means the strike price is very close to the current price of the stock. Okay, so the 260, 250 calls, which is in the strike price here in the column here, here's price of Apple, 263. So those pretty much line up. And in your option chain, so here's what I have: delta, gamma, vega, theta. So the most important to me is delta. Here's the delta column, and here's the theta column. Deltas range from 0 to 100%. So here we go. The lower strike on the call options have a higher delta. As you go more at the money or out of the money, the deltas get really small. Okay, you can see these 310 calls have a 2 delta or 2%, whereas the at the money 250 2.5s have about a 53.5% delta. So that means if Apple jumps up $1, these 262.5 calls should move up about 53 cents per contract, or about 53% of whatever Apple stock does. Okay, theta in this case is 15.6 cents. It's listed as dollars and cents, but most of these are in cents. Okay, so this is 15.6 cents. Today, if Apple didn't move anywhere and we flip the calendar to the next day, this option contract price right here, which is worth about $8.22 per contract, right somewhere right in the middle, is going to be about 15 cents cheaper tomorrow, just because we're moving on towards expiration day. You don't have to do anything. That option is just going to lose value overnight. So if you're the buyer of that option, the money's just going to disappear from your account because we turn the calendar to the next day. I'm going to show you the option calculator. I'm going to show you how that works. So what you need to know is, so we're looking at the at the money. So here's the theta, 15.6 cents per day. If you go more in the money, higher delta, let's look at these 90 delta options, which move a lot more when the stock does. That only has a 9.4 cent theta decay. So if you want to get more movement out of the option price, you choose a higher delta option. That means it can move about 90% of what the stock does. It's going to cost you more. It's going to cost about, this is a $27 option, which is actually $2,700. $2,700, where these at the monies are worth $822. So you're going to pay more for these things, but you get more movement and you get less theta decay. Now, if we go out in time, as I said, the longer out in time you go, there's less theta decay. So let's go out to September of 2026, almost a year out in time, about 11 months out in time. And you can see the theta for these 90 delta options are now 3.8 cents. So it's smaller than the nearer expiration of November we just looked at. And these at the monies, which is going to be the 265s roughly, have only a 5.3 cents theta. So it's a lot less than the 15-cent theta. So the more time you give, the less theta, but of course the option is going to cost a lot more. So it's all a balancing act. It's all about how much money you can afford, how much delta you want to get, and how much theta you're willing to, be a part of your call buying plan. So let's take a quick look at the option calculator. That's the cheat sheet. Let's go to the option calculator here. Barchart.com, free website. Go to barchart.com, click on the options tab here, and open up the options calculator, okay? Now, Apple defaults in here. I want to show you how these numbers work. Here's the inputs on the left. This is how option calculators work. Inputs on the left, outputs on the right. Now, you can see theoretical price, that's what the price is, and here's your delta, and here's your theta. So it lists all the Greeks. These are all called the Greeks. Gamma's based on, we don't really need to worry about that so much, but there's actually 5 of them. I don't really concentrate on those except for delta and theta. Those are the most important to me. All right, so here's what's going to happen. You're going to see Apple's at 262.82. Here's that strike price, 262.5. And in the option chain, let's go back to that real quick. The 262.50s were worth about, what I say, like $8.22. So in the option calculator here, they have it, bar chart has it valued about $8.10. So roughly the same, I think, because the price is a little off. The current price of the stock's a little bit different. But you can see the delta is about 53%, which is exactly what it shows in the option chain. And that theta is that roughly 15.4 cents daily decay. Now I want to show you what happens. I'm going to take the days to expiration down by 1 day, down to 26 days to expiration, and you're going to see this option value decay about 15 cents or so. So this thing should be worth about $7.95 when I change the number to 26 days. Okay, 26. Okay, so you can see exactly what happened. So if you bought this call option on Apple yesterday, and now we turn the calendar to today, you can see you've just lost 15 cents or $15 of value. Okay? So it went from $8.10, which is $810, and now it's worth $795. So you just lost 15 cents, $15, I should say, just because we turned the calendar to the next day. And now the theta gets even bigger. So if we go knock this down to, say, 20 days, and this is all assuming that the stock price is staying exactly where it is. Now you've just lost a few more days, and now it's down to $6.96. Stock price hasn't moved at all. So if you're going to concentrate on these shorter term expirations, you better make sure that that stock's going to move quickly, or else you're just going to give all your money away to daily decay. So let's bring this back to 27, and now it's back to $8.10. So how do you rectify? How do you get past daily decay from eating your potential profits? Well, the stock has to move up, where you thought it would be. So let's just take this down a day, 26 days, and we have to see how much the stock price has to move up in order to get this thing back to $8.10 to where it was before. So now we have to figure out, well, how far does Apple need to go? Let's bump this up to 263, which is an 18 cent per share upward. So that's not there yet. So 263.10. Okay. So basically, Apple stock price had to go up to 263.10, which was about a 50 cent upwards movement, just to get yourself back to break even with 1 day knocked off. Okay. All right. So let's take a quick look let's bring this back to the regular numbers, 27 days. And this was, what was it? 262 something, 262, I think it was 262.62, 262.82, I think it was. Yeah. Okay. Now let's take a look at a different strike price. Let's look at what was the 90 delta strike on those? The 90 delta strike was the 237.5. Okay, so let's look at the 237.5 calls, 237.5, and that thing's worth about 26.51, and in the option chain it was worth 26. It's probably worth about 27 here in the real market, but bar chart, it's got it a little bit cheaper. So let's see what happens. You see the theta is about 9.8 cents. So this thing should drop about 10 cents. Okay, a little. That's definitely less than the at the money one. So we take this down by a day. This thing should be worth about 26.41. Okay, let's knock this down by 1 day. And there you go. So not so much. That went down by what, 7? Oh, I'm sorry. The theta down here is only about a little less than 7 cents per day. All right. So if you're using the in the money strikes, it has a higher delta, your theta is not going to be so much. So there it is. You need to understand that if you're going to buy options, that stock better move quickly and it better move in your favor. Now let's just assume that. Let's go back to the 262.5s. Okay. And we got 27 days left. Now, these calculators are great to do the what-if calculations. You can play around the numbers to see, what the option value might be worth on certain days. Now, we're back to the original. Now, let's just say you go down by a day, but Apple stock moved down to like $261. Now the thing's worth $7. So not only are you losing money to theta decay, but you're losing money because the stock price is moving against you. So you got to really be careful that if you're going to play these short dated options, that you really are good with your stock picking direction and your timing. I mean, getting the direction is one thing, but getting the timing at this together is a really hard thing to do. That's why I always tell my new students, you need to give yourself more time in order to be correct with, you got to make sure you have enough time for the stock to move in your favor. So you got to go out further in time. The option is going to cost more, but you're giving yourself more probability to be correct. Now, I also mentioned that it's very important to understand your break-even price, because just buying the option is one thing, but you also need to know where the stock needs to get to in order to just break even. So let's go back to the option chain real quick. And if you're buying these 262.5 calls right here for, let's just say, $8.25 per contract, somewhere in the middle. In order to find your break even, you have to add the option price to the strike price itself. So let me get out my calculator here and just do a little math real quick. So we're looking at 262.5 plus 8.25. Your break even is $270.75. $270.75. Apple needs to go up about $7.75 roughly in order for you just to break even. So if you're looking at the delta of these saying, oh, well, there's a 53.5% chance of my option being in the money. But just because, let's just say Apple closed at $263 at expiration, well, that option would be in the money technically by 50 cents per contract, but it would only be worth 50 cents a contract, and you just paid $8.25 for it. So you actually be losing money. So your real break even is $270.75. So you need to know, what is the probability of that? Well, you can look at the delta of the 270 calls roughly and see the delta here, a little bit above it. So I'd say that the probability of actually winning at this point is about maybe 37%. Okay, now what we can actually do, if you want to know the exact, number, we can use our handy probability calculator that we have on our website. So let's just type it in here. Let's say Apple's at 262.82, I think was the number, and we're looking at the third Friday in November, which is the 27 days. And the future volatility of Apple at that point, you can go at the money 26.6%, which matches up with the IV here. So let's put in 26.7%. We'll round up 26.7. And we want to know, so the break even is 271.75. That is your break even price. And it's probably going to be, as we said, about 37%. Click on go. All right, so it's a little less than that. So what you want to do is concentrate on here, finishing above highest target. So you want to make sure or see what your chances are of Apple stock finishing above just your break even. And it's about 32.26%. Conversely, there's a 67.7% chance that Apple's going to finish below your break even. So just because you're buying the at the money option doesn't mean that's your chance of winning. You got to add in your break even point to figure out your actual true probability, and it's right here, 32.26%. Now, if we were to buy that in the money option, let's go back to that. Look at the chain here for a second. If we were to buy the 237.5 calls for $27 per contract, so that would put our break even at 237.5 plus 27. The break even would be $264.50, $264.50, which is only $1.50 more that Apple has to get up to just to break even percent. So let's go back to the calculator here again. And 264.50, I think was the break even. 264.50. Click on go. So if our break even for the option is 264.50, which is not that far above this price, so the option has a little less than 50% of just breaking even. Here it says finishing above highest target, which is what we need, 46.5%. Okay, the option in the option chain, the delta once again tells you the chances of it being in the money at expiration. But as I said, you have to look at the break even price. So if our break even price is just under 265 here, so here you can say it's a number between these two. So it's about, should be closer to 50%, 49%. So the numbers are a little off through the option chain and the calculator. But once again, we go back here. It has a much higher chance or a better chance of hitting the break even than the at the money option, which has a higher break even point up at like 271 and change. All right. So you need to understand your delta, need to understand the theta before you buy a call option, because if you're not very good at picking the stock direction or you don't know the timing, you better give yourself some more time or choose a higher delta options, because those will have less theta and they'll move a lot faster when the stock does.